Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, with the S&P 500 on the verge of bear market territory. What should long-term investors be doing right now? Let's talk to a firm that specializes in that. Gerard O'Reilly is co-CEO of Dimensional Fund Advisors. Dimensional has $659 billion in assets under management, and Count Nobel Economics Prize winner Eugene Fama on their board. Also joining me, our old friend Dave Noddick, financial futurist at VettaFi. That's the newly renamed company, formerly known as ETF Trends. Gerard, even the long-term investors might be tempted to pull money out of the market right now. What are you telling your investors to do now, and what does history tell us?
Well, Bob, it's always important to set expectations correctly. And the right expectation for investing in markets is that they're risky. You wouldn't get a higher rate of return investing in the stock market than the money market fund if they weren't risky. And that's in all times they're risky. So our view is you got to stay disciplined, you got to stay well diversified, have the right mix of stock, cash, and bonds that fits you, and ride out these volatile times. And a financial professional or a financial advisor can really help you do that. There are ways to make it more risky, and that's by trying to time markets, by sacrificing diversification, chasing fads, or by sacrificing discipline for panic when markets are volatile. And all those things make it such that time stops working for you, and really staying disciplined is what's important right now.
Yeah, I want to talk about the perils of market timing later on, but Gerard, I've heard your founder, David Booth, say Dimensional is dedicated to implementing the great ideas in finance. What are those ideas? What's the ideology behind Dimensional? I think it's important we remind everyone about what you stand for.
There's a couple of aspects there, Bob. One is that prices in publicly traded securities are forward-looking. They look to the future. And that means there's a lot of information in market prices that you can use to manage risk and increase expected returns. The second is optionality has value, and it's important to stay flexible, because if you know how, you can capture that value on behalf of your clients. And those two principles we apply through systematic strategies, so you can think indexing, but then indexing beyond what an index can do, and applying flexibility to add value. So it's low cost, well diversified, reliable, repeatable, but with value add over conventional index approaches.
Now, Dave, what about that investment thesis? You know, we've often heard Gerard talking about the tilt towards value and small caps, and certainly that's in line with all the long-term research that exists, but we've seen underperformance for several years in those two asset classes. Is this their time to outperform? Where are you as a ETF watcher stand with all of this?
Yeah, I mean, it's hard not to look at what's gone on, particularly with international value, and not get a little bit excited there. And Gerard didn't mention them, but DFIV, which is one of the funds in their lineup, their international value fund, is not only the best performing international value fund out there, it's about the best international or value fund that you can find out there, trading about flat on the year right now, which is honestly a victory given the markets that we've seen. There've been recent polls that Bloomberg did looking at the propensity of folks to want to be a value investor in a down market like this. There's no question that there's a lot of folks looking for that in this kind of environment. But I think the core point Gerard's making there about diversification and cost control being really the secret sauce in a bear market, I think is very true. We've seen this before when we've had big pull downs in the market. Folks go to lower cost products. Sometimes that's switching into an ETF out of a mutual fund, and they go towards broad diversification. It's the two things that we know work over the long term, and they're two things you can actually control.
Yeah. You know, Gerard, investors are a little bit spooked that the Fed is going to overshoot and induce a recession. Tell us about what your research indicates about investment returns after sharp downturns.
So, Bob, and thanks for the shout out, Dave, on international value. Appreciate that. You know, after a sharp market downturn, Bob, you can look at subsequent 1 year, 3 year, 5 year returns, and what you find is that they, on average, have been positive. So a sharp downturn may indicate that a recession is in store for the real economy, but not necessarily. There's many examples where markets have gone down and not been followed by a recession. But they do not indicate that you should expect future declines. It may happen, but on expectation, staying invested for the long pull, you'll likely be rewarded with those positive returns.
So I think the point, Gerard, is a negative year, which we may have this year, does not imply another negative year, right? And also address this inflation issue. You've said, I've heard you say before, that there's two types of inflation, expected and unexpected inflation. Can you sort of clarify what you mean by that?
Yeah, there's expected inflation, Bob, and you can look at market prices to understand what's expected. You can look at break-even rates of inflation to see what's expected over the short pull and over the long pull. And in particular for the next year or so, inflation is expected to be higher than average, 5 or 6% if you look at break-even inflation rates. That's already priced into markets and it's expected. Now, markets can't predict the unpredictable, nothing can. So when it comes to inflation, I think the key things to keep in mind are you can outpace it or you can hedge it. Stocks, bonds, those types of investments have tended to provide positive real rates of return, even in periods of high inflation. And then you can buy inflation-linked products that allow you to hedge it. So you can plan for unexpected inflation. You just can't predict when it's going to happen.
Yeah, Bob, I think it's also important to point out we're looking at a couple different kinds of inflation hitting us all at once here. Everything from food inflation and energy inflation coming out of the war, but also increasingly it looks like we're going to have substantial supply chain hiccups coming out of Asia for the foreseeable future. It's really difficult to get a point solution that's going to protect you from all of those potential sources. So again, I reiterate, a good, well-diversified portfolio of low-cost alternatives is probably your best bet.
Yeah. I want to talk about your ETFs, Gerard, a little bit. Dimensional has become one of the top 10 ETF providers out there. You achieved that a short while ago. You've converted several mutual funds to ETFs in the last year. What was that journey like? You're sort of the leader in this conversion space.
Yeah, Bob, we have 24 ETFs now, 7 of which used to be mutual funds. We converted into ETFs, and all the remainder were new launches. So we have 19 equity, 4 fixed income, and then 1 REIT fund. It's been a whirlwind 18 months, and it's amazing to be in the top 10 after just 18 months. The conversions were largely driven by what was the right thing to do for the clients. We realized that we had tax-managed funds, that we could do a better job achieving the investment outcome if we converted those to ETFs. But it was quite a journey. We had to do that and orchestrate it across 45 different markets around the world, over 50 different platforms here in the US, so that our investors went to bed on a Friday night with mutual fund shares and woke up on a Monday morning with ETF shares. And we just went through the most recent one a couple of weeks ago. Went smoothly, and so far all the feedback has been very, very positive about that conversion.
Well, you've been a leader in this space, so that's good to hear. Now, you've got several equity ETFs. Your largest one is the Core Equity 2 ETF. That's DFAC is the symbol. I'm looking here, the largest holdings, Microsoft, Apple, Amazon, Berkshire, Johnson & Johnson. This looks like a quality portfolio. Describe what the methodology is. How do you choose what goes into this?
So in that particular strategy, what you'll find is that we sort stocks based on their market capitalization, so how big they are from big to small, on how cheap or expensive they are, so price-to-book ratios from high prices down to low prices, and then from profitability, those with the highest profitability, those with the lowest. And then we tend to overweight those companies that have smaller market capitalizations, lower relative prices, or higher profitability, so a combination of all those three. But it's overweight with respect to their weight in the market. So what you find is that large cap stocks are generally held underweight, growth stocks are generally underweight, or stocks with lower profitability are generally underweight relative to their weight in the market. And we believe that that improves the expected return of that strategy. And in periods like what we've had, Dave alluded to it, where we've had strong value premiums, those strategies then tend to outperform the market when value stocks or small cap stocks are outperforming.
But Gerard, I think it's
so
also
your point
important,
is, so for example,
like you're not actually indexed to a specific benchmark. How much flexibility do you sort of implement when we have big trading days like we've had? I mean, stocks like Walmart and Target moving 10, 20% is a pretty unusual environment. Are you actively trading in and out of positions in those types of markets?
Yeah, you're 100% right, Dave, where we're not indexed to a particular index. We're broadly diversified. We have low turnover. But our view is that you should implement that turnover over all 250 trading days of the year rather than 2 or 3 times during the year. And in time periods like what you mentioned, Dave, I think they're very illustrative of being able to put client flows to work, because stocks reorder themselves What was growth becomes value, what was value becomes growth. So by looking every single day, what it allows us to do is work our way out of positions of stocks that have gone up relative to the market and into positions of stocks that have gone down and are now value type stocks. And I think that stands to keeping the strategy focused on the asset category, because what you find from our strategies when compared to indexes or when compared to our peers is that when things like value or profitability or company size, those premiums are positive, we're outperforming our peers and benchmarks. And that's in part because we can stay focused on those asset categories much more efficiently than an index-based approach, as you alluded to, Dave.
So if somebody were to just look at this and say, well, look, you've got Apple, Microsoft, Amazon in here, the three of the biggest stocks that are out there. Your point is they're in there, but they're actually underweight their actual market weighting. And so other stocks get higher proportional weighting overall. I mean, that's the point here, right?
That's the point, Bob, because every investment, every limited liability investment is a good investment at some price. Just different investments offer different expected returns to investors, and our objective is to, in a risk-controlled way, improve the expected return or the expected outcome that investors can enjoy. And that's what a lot of our strategies seek to do. We think the market is a great place to start your asset allocation from, but then if you're in pursuit of higher expected returns or you want to manage risk in some particular way, having these weights that deviate from market weight to increase returns, we think is important.
Yeah. Now you've got, I want to move on to the bond ETFs and talk a little bit about fixed income. You've got several diversified bond ETFs. Tell us a bit about what investors, first off, should be thinking about the Fed and about interest rates right now.
Well, I think there's a lot of focus on the Fed, as there always is, but the market understands what the Fed is saying, and the market has that priced in, and you can look at the market for what the expected increase in Fed funds rate is by the end of the year, and it's over 2%. That's already reflected in market prices. Our view is that the Fed funds rate is one rate, but there are many hundreds of rates that are going to drive the returns of a well-diversified portfolio. And so what we try to do is have a systematic approach that inputs those many hundreds of rates from around the world and then improves the return characteristics of the portfolio. So, for example, you have bonds issued in euros, in British pounds, and so on. You have different credit quality bonds. You have different duration bonds. And again, the market tells you who has high expected returns right now and who has low expected returns. For example, if you're in the short end of the market, the highest expected returning play is from 2 years to 1.5 years. So you could have a short duration portfolio that doesn't have to go all the way out to 5, but still have high expected returns because that's what the market is telling you it's offering right now.
And Gerard, we've often heard people coming on our air trying to pick bottoms. This is, of course, an obsession with active stock pickers. They talk about buying opportunities. We hear this all the time. It's useful now to reiterate what the academic research says about this. What do you say to people trying to pick bottoms or time markets?
If you're trying to time markets, Bob, you're just increasing your overall risk of investing in markets. And that's in part because when those positive days show up, they show up fast and they often are big. So for example, if you were to look over the last 30 or 40 years and you were to invest in the S&P 500, and you were to put $1,000 in, as you're showing on the screen here, it would have grown to $138,000 or $140,000. You miss 5 of the best days, and that's down to $90,000, so 30 to 40% reduction. And that's not to tell you that that you should or shouldn't be timing markets. It's to tell you how challenging it is to time markets, and that it's not a game that's worth playing. You're probably going to end up losing relative to a strategy that stays the course. And that's why, Bob, we've introduced these 24 ETFs because it allows us to build models and allows the financial professionals that we work with to build models across a broad range of asset categories in equity and fixed income and kind of ride through those various different times in the market.
Yeah. Dave, you have written about this yourself many, many times. Gerard's point here about the 25 best days and the 5 best days, it doesn't really matter what time period. I've noticed you could take it over a year. If you're not in on the 5 best days, your returns are noticeably different. You could do it over a 10-year period. If you're not in on the 5 best days, you could do it over a 25-year period.
And it doesn't matter whether the market's
It's really rather
going up
remarkable.
or down.
It's a very simple way to understand this. This is why I like doing it this way. It's very easy to understand.
Well, it turns out the only market timing that really works is dollar cost averaging, right? If you're always buying, then you have the opportunity to pick up those down days in the market and to be a buyer on those days as well. So, staying invested and just keep buying has been a pretty tried and true strategy for the last 30 years.
Yeah. What else, Gerard, at this point, would you have in terms of advice about things like market timing? This is a kind of situation now where I think you really do want to emphasize what the academic literature indicates. We know that generally market timing does not work, and you've demonstrated that just in that simple way. But what else? What other kind of advice would you give to people now? For example, risk profile is a major issue. People have a hard time understanding their risk profile, actually, I find, because people are used to the market going up for the last 13 years. So people say, yeah, I have a high risk profile. And now the market, is 20% off its highs. And a lot of people are finding out that their risk tolerance may not be what it was or what they thought it was. Any advice on that front, on the risk tolerance front, understanding it?
Yeah, I think that after you've experienced a time period like this, Bob, you may learn something about yourself and your own risk aversion or your risk tolerance. And that may be a reason to change your asset allocation because you've learned something new about yourself. What you filled out in a risk questionnaire is not actually how you react in the real world. But absent that, I think generally you want to stay the course. And that goes back to some of the remarks that Dave mentioned, which is about time and time in the market, not timing the market. As Einstein has attributed to have said, those who understand compound interest earn it, those who don't pay for it. And compound interest being the 8th wonder of the world, I think it's really important to get that time in the market in a disciplined fashion for you to achieve investing success.
Yeah. I agree. Compound interest is the most important thing to understand with the stock market, which is why whenever I have to write some introductory course to long-term investing or introductory article for CNBC.com, I always start with compounding interest. And 5% of $1,000 over 1 year doesn't sound like much, but compounded over 30 years, the numbers really get big at the tail end. That's what always amazes people. When I do this on a chalkboard in front of a room full of people, 5% of $1,000 is $50. And 5% more after that doesn't sound like an awful lot, but over 25 years or 30 years, the numbers get very big. They get eye-poppingly big once you start getting out into the couple decades area. And that's when people really sort of grasp the concept of compounded interest. So I think that's the most important thing.
I agree with you, Bob.
And it's kind of, Gerard?
Yeah, I agree with you. And I think it's kind of the illustration is that if you jump off that curve before you get onto the steep part, you're starting all over again. And so you got to stay on that curve if you want to get to that steep part of the curve where it really makes a big difference.
It also means capital preservation is incredibly important, right? You don't want to be the person who's, sort of selling out right now, putting everything in cash and then waiting until the market's, had a 20% recovery before you get back in. I'd point out a 60-40 portfolio still beating both bonds and stocks this year.
Yeah. One of the most heartbreaking things, I've been at CNBC 32 years and the stocks correspondent for 25, was what happened from December 2008 to March 2009. You'll recall, of course, gentlemen, you were there, that we were down almost 50% from I think it was September 2007 to December 2008. And that's a big drop. People were traumatized, and at the end of November, a modest rally began, and it continued for several weeks into December. I think we rose 15%, and a lot of people, all the technicians came out and said, well, okay, there's now some bottoming process coming in. And of course, it didn't happen. In the beginning of January 2009, the market went down again till it didn't stop until, I believe, it was March 6th of 2009. And in that period, in that 2 months, that's when I saw the most despair. That's when I saw people selling And that's when I became a believer in behavioral economics, a true believer in it. I'd known about it before, but selling with the market down more than 50% is certainly not terribly rational behavior. And yet we saw that mutual fund redemptions actually increased during that time period. So I take these moments are especially meaningful to me because I saw a good part of my generation, the baby boomers, sell at the bottom. And we didn't know where the bottom was. Nobody knew. I didn't either. But I know that the market's down 50% is not when you start selling. So, Gerard, I know you've had this conversation with many people, but we really appreciate your the steady hand and the sobriety associated with it. Dave, your firm had a big announcement last week, changing the name from ETF Trends to Verify. What's that all about? Tell us about that.
Yes, so Verify is an umbrella brand now, brings in ETF Trends, a couple of other firms that you may know like Illyrian and S Networks. But what you can think about us as is really a fintech company with deep thought leadership, deep expertise, deep data, and deep technology that really help us connect investors and investment managers. So our goal is to sit in between the average investor, financial advisor out there, and all these folks who are cooking up products out there in the street and helping everybody understand each other. Hopefully that leads to better outcomes for everyone.
Well, your ETF Edge has always been one of the more, your company has always been one of the more dynamic ETF companies that are out there. So I appreciate your change, and of course I'm going to be following that very, very carefully and see what's going on with what you guys have been doing. So Dave, congratulations. Tom Lydon as well is also out there doing exactly what you've been doing before. So congrats on the name change. ETF Trends now is Verify. And that does it for this week's ETF Edge. My friends, my thanks to Gerard and Dave. We've asked Dave to stick around and chat a bit more about ETF Trends on ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.